my hero is telling me, no, just buy the index fund. And I did the math on it and I realized that he was right. Would you rather have a nice car or a cheap car? You'd like to have a nice car, but you'd like to have it as cheap as possible. In investing, you get what you don't pay for.
Welcome back, investor. We have another episode of Passive Income Adventures, and we have a little bit of a different episode for you today. We've got Kevin T. Carter calling in from San Francisco. Thanks for being with us, Kevin.
Thanks for having me.
Yeah, so Kevin, I'm gonna just read this bio. I don't normally do that. I usually let you introduce yourself, but I want to get some of this out of the way early on so we can dive deeper into what it is that you do. Kevin, Chief Investment Officer of EMQQ Global, founder, including several other index funds, considers yourself to be an Omaha style value investor, first and foremost, but you have collaborated with Princeton economist and indexing legend, Dr. Burton Malkiel. So this indexing, we get into that on the show a lot. So I'm really interested to dive deep into your experience in there with the early days of indexing and index funds. Also, you pioneered the development of e-investing, online trading platform, so to speak, that you sold to E-Trade in 2000. And I think that's really changed the face of how people invest in public markets. The technology really advanced that. And would love to talk about kind of the old school stock investing clubs, what those look like now. And then finding active index advisors, a pioneer in the direct indexing, acquired by Natixis Asset Management in 2005. And so you're currently focusing on various funds in emerging markets, China, India, Brazil, in particular, Mexico. And so with all of that out of the way, let's have you tell us from your own perspective what your early investing days look like. Bring us up to the present day from your past and your experience and how you got to where you are right now.
Sure. When I graduated from college in December of 1991, I had one interview in downtown San Francisco and we talked about college basketball for 20 minutes. Then the guy said, you can start Monday. And I said, I don't know anything. And he said, go buy this book. And he wrote down A Random Walk Down Wall Street, which is a book that some of your listeners may have heard of. It was written 50 years ago. And in the first edition of the book, the author basically laid out an idea, which was to make an index fund, and in 3 paragraphs detailed what it should be. And so I read the first book I read before I even showed up to work on Wall Street was about indexing. But I quickly, when I got to work, I realized that I'm more of an Omaha person when it comes to investing. And I try to look at every investment and business decision through an Omaha lens. But for the last 25 years, I've been partners with the guy that essentially invented indexing. So I've got a perhaps unique perspective because I've done both sides of the spectrum, if you will. And I also became an idealist. I could see all the problems with the traditional mutual funds and the riches being made by the mutual fund company owners while the investors in traditional mutual funds lagged the market. And when I read the Berkshire Hathaway report 20 years ago, or only 30 years ago, the 1985 Berkshire Hathaway report, Warren Buffett himself said that most people, including institutions, should just buy index funds. And I was a little bit disturbed by that because I was praying towards Omaha. It's my hero is telling me, no, just buy the index fund. And I did the math on it and I realized that he was right. The average mutual fund can't do better than the market. And if the average active mutual fund charges 1.5% and the index fund is basically free, then the index fund investor is going to beat the market by 1.5%. That doesn't sound like a lot, but when you compound for 20 years at that rate, it ends up being 2 or 3 times as much money. And so I became this idealistic revolutionary. I wanted to kill the mutual fund business. And so I invented this ability to trade stocks in fractional shares. So you could invest normal dollar amounts straight into stocks without buying a mutual fund. And the company you mentioned, the product was called Build Your Own Fund. Cut out this whole layer of these Boston mutual funds with billionaire owners. And so how I reluctantly became an entrepreneur in 1999. It worked out well. We sold it to E-Trade, as you referenced, in the year 2000. And then my partner, the Random Walk guy, started this thing where you build your own index. We called it active indexing. Now it's called direct indexing. And you can do this now with Schwab and Vanguard. I think Vanguard calls it personalized indexing. But both of these things that we invented are now mainstream. But as with a lot of new ideas, at the beginning, everyone said, that's dumb.
Yeah.
Why would you do that? No one's going to do that. And So you don't really realize, but it worked, and it's now a huge part of the investment sector. So call it my investment Peace Corps years. I was trying to fix the system and level the playing field so the average investor had less layers of cost to investing in the stock market.
Okay. Fascinating history. It's almost like struck gold twice on the entrepreneurial side. Can for our average listener, we're joking before the show started that you're gonna have to explain this to me like I'm a bright fifth grader because I don't even know if I can have a knowledgeable conversation on some of these topics because I this show really heavily focuses on private markets with the real estate emphasis, but we talk a lot about diversification. And so in in our quest of being well diversified, I really wanted to jump more into some of the public markets that you're dealing with and just learn a little bit more about, and especially your history was fascinating because I'm a big index fan. But tell us the difference between indexing just at a basic level and just value investing. Is there how much of a difference in there? I've even heard when I looked it up recently, Warren Buffett hasn't beat the S&P index for quite a number of years. Is that true? And if so, why the two different philosophies? Are they more similar than we think?
First of all, I don't know if Berkshire Hathaway's beaten the S&P over the last several years. I would guess not, but I don't think that's the Warren Buffett would tell you that he doesn't care about that. That's not, measure yourself that way. You certainly don't measure yourself over short-term periods.
Mhm.
It's all about the long term in Omaha. So the way I think about the investment continue, if you think about on one end, you have active, right, picking stocks, you got the Warren Buffett Omaha. The other side, the other end is just by the index,
Okay.
right? But rather than think about them as being completely on the opposite, the best way to think about it is a circle that doesn't connect, where
Like orbit.
indexing and Warren Buffett are as close as you can be, but they're all the way on the other end. And my personal belief is that almost everything in this area is garbage. And
Okay.
the two things that you should do is either just buy the index or do the Warren Buffett, Charlie Munger thing, which is a lot harder to do than it sounds. But it basically means buying and holding great businesses at good prices for the long term. And now, historically, one of the problems that persists still is, and this was an issue when I started in 1992, you had to be either active or passive, right? Active or indexing. Now, the active people had way more assets, and so the indexing was just a little pesky thing in the corner back then, but it was still the first kind of debate. What do you do? And then within the active side, there was a whole nother battle, which was value or growth.
Okay.
And the way the entire world was divided, even the Morningstar style box was, could I only be value or growth? There wasn't even a middle at the time. And I thought that was crazy because, first of all, value investing, Ben Graham, the guy that taught Warren Buffett, back in the 20s and 30s, that meant you want to find companies that are worth a dollar that you can buy for a quarter. Right.
Mhm.
And when annual reports came in the mail and quotes were on chalkboards, it probably was a lot of probably options. You could say, oh, look at this company's got 100 million in cash and its market value is only 10 million. Guess what? Everyone's got a computer now. So all of those things that used to exist, the traditional value investing, they've gone away. The value investing people, I don't think they necessarily realize that Charlie Munger changed Berkshire Hathaway in a way that redefined what value investing became. And there's lots of quotes about this, but it became not trying to buy the cheapest business, but buy the best businesses and hopefully at a good price. But because there's the value trap, if you will, which is a term people use, it looks really cheap. And I think it's very clear that Warren Buffett evolved and it had a lot to do with Charlie Munger's influence. Think about this. You know what Hathaway was from Berkshire Hathaway? Hathaway was a men's shirt maker. And factories in New England where they made shirts, like button down men's dress shirts. And it looked really cheap. And Warren Buffett lost all of his money in that. As he says, if he had never bought Hathaway, the price of Berkshire would be twice as high because it was a huge setback. So that was old school value. It looked cheap. Now it's all about the moat, right? And so I think that ultimately, when it comes to value investing, the valuation multiple that matters is the PEG ratio. The PE doesn't mean anything without the growth rate. And I think that Peter Lynch did the most to extend this concept of it's not just the value, it's the growth rate because you're buying the future, right? And the future earnings. It's the earnings that make companies valuable. If you got a company growing 50%, then a PE of 50, perfectly fine, right? If you have a company growing at 10%, then if you pay a PE of 50, you're probably going to lose your money or some of your money. So value is a price tag element and growth is a business element, right?
Okay.
It's like saying, would you rather have a nice car or a cheap car, right? You'd like to have a nice car, but you'd like to have it as cheap as possible.
Yeah.
And that's what value investing is, I think, and certainly what Berkshire Hathaway has become in terms of value investing. In terms of index investing, the reason indexing works is because it's free, right? And so you get whatever the market gives you. You don't pay 1.5% to some other person who probably isn't going to beat the market. As John Bogle says, in investing, you get what you don't pay for.
Yeah. So you get to basically keep those fees. What are the things in between that you're saying? So on in the middle of the horseshoe, what's there that you're like, don't buy?
Enhanced indexing, quantitative strategies, having 50 or 100 stocks and being active. Once you own 50 or 100 stocks, you're going to have the stock market return. It's a mathematical fact. Now, if you're saying you're competing with the S&P 500 and you're buying companies from the Russell 2000, maybe it's not the same, but if you're diversifying, once you get to 50 stocks, you basically have the market,
Kind of
right?
an
And so it's hard. In a perfect world, the way it would work, you'd find this portfolio manager that was good. And you'd say, here's my $100,000. Put $10,000 into each of the next 10 companies you bought. Because again, a portfolio manager has 100 stocks. Some of them he might have bought 20 years ago. And even worse, if it's a traditional mutual fund, if that stock's gone up a lot and you invest in that fund, you have to pay part of the taxes if they sell it, right? Which is crazy. The reality is, if there was a bunch of active managers that were running three, four, five stock portfolios, I would say those are the kind of people you want if they're good. But once you start getting diversified, active, you just aren't going to beat the market.
Yeah, but isn't that what the traditional mutual fund managers are doing? They're value investors, but then they're sharing that with the passive investor. Isn't that what they're trying to do? The mutual fund managers I know are managing very small baskets, a dozen stocks maybe, but they're still not beating the market. So I've always been a little confused. Like, why would I pay you when I could do better for free over
But
here? And
you also, just because you have less stocks doesn't mean you're going to beat the market. In fact,
Sure.
odds are a lot higher you're going to either beat it or miss
Or
it by a
lose.
lot. But in my experience, the number of mutual funds that have that concentrated of portfolio is almost none. So the 99.9% of the mutual funds that invest in publicly traded stocks, they own at least 50 stocks.
Okay.
But it's hard to beat the market. There's no doubt.
Yeah. But that it's
At least the United States equity market.
yeah. And this is where we get in the emerging markets. But what I'm hearing you say from the value investor side, it sounds a lot like what we're doing in private markets because there's no way to index the private market. At least we don't have the technology yet to be able to say, okay, we're going to have a basket of thousands of private companies that you can go and index this or index that industry. So what we're doing over there is like single stock picking. We're investing a lot of money in one company and it's not as diversified. So we're trying to basically say private markets tend to outperform public, but is my private portfolio going to outperform because I can't diversify as heavily through private as I can through public? So I'm hearing what you're saying there and being like, okay, we bought an apartment building. It was ugly. It was cheap. Was it a good deal? Not really, because it ended up costing more money to keep it up and fix it and all that. And then we hopefully make money when we sell it type of situation. Not a great cash flow. And I see a lot of new real estate investors, especially falling prey to what you're talking about. They just go and buy like some class D building, strip mall or apartment building, and they become trying to bring it out of the slum, but it's almost an impossible task. And then after some experience, they realize I don't want these cheap properties anymore. A 12 cap doesn't look that great when you realize why it's a 12 cap. So those types of concepts seem to be pretty similar between value investing and what we're seeing
Right?
there.
You want the corner of Maine and Maine.
Yeah, location, but then we're buying class D properties because they're cheap and most of us don't want them. So is that I'm understanding that correctly? Am I summarizing that? Or
No, you want to buy in the stock market, you want to buy the premier businesses. You want to
okay.
buy great businesses because What makes a company valuable is it profits. A great business is a business that's great at generating profits, right? And the world's competitive. If I make a table for $10 and sell it for 100, then you're going to make tables and sell them for 90, and pretty soon tables are going to sell for $11. The most important word in this is moat, MOAT. And a moat in investing can be a logo like Nike's, where anyone can make a pair of shoes for $12, but Nike can sell them for 150 because of their moat, their brand equity.
Yes.
You now have new age moats like Facebook, which have the network effect, where you and I could start a social network pretty easily. We could find a couple of college kids and it would look just like any of the other social networks. But if nobody's on it, it doesn't have any value. So it's the moat that you're looking for in real estate that takes a different form, right? It's location. Of course, price matters as well. You can say, oh, I found this Class D property and it's really cheap. But what you want to find is property on the corner of Main and Main that is a value, but it doesn't happen naturally, right?
No, yeah,
Unless
it's really hard to find good deals on great businesses. Value add, I think, is maybe more what I'm thinking, where we get a business we can add a lot of force a lot of value into through improvements, not just natural appreciation, but we can force a lot of value to it and we got it for a good deal. So we want to give our investment a little bit of high heels or a little bit of a boost by getting it for a pretty decent deal. And then we're going to stuff a lot of value into it as well. So we're coming at that from both ends there. What does that analogize to?
I mean, there's obviously certain types of investors that are activists that would consider themselves doing something like that. We're going to go in there and buy enough stock that we have a stake on the board and we can get them to make these improvements or changes that help us. But it's probably more akin to like just finding things that are out of favor, right?
Mhm.
Waiting for the market to realize that it's not the average investor can go in and tell Starbucks to reduce the menu items on the
Yeah.
menu and cut back on certain investors try to do that, are successful in doing that. But most investors don't have that kind of control over their publicly traded stocks as you would if you bought a piece of property and owned the property yourself.
So it's more like looking for companies that are actively building, trying to add value, and that for whatever reason, I don't know, NVIDIA and DeepSeek, you're going to buy it when it's having a little bit of a tough time, but you know that it's the kind of company that's going to come roaring back and continue to add value to the marketplace. That might be more what we're talking about. Not that we have direct control over, but that we're looking for companies who are moving up the value add scale little by little as they basically make their industry better. I don't know. That to me is more like stock picking, and I guess I'm just an index fan.
Algebra is on your side if you're an
Yeah.
index fan. It's indisputable that in the United States stock market, the index is going to beat the vast majority of the active managers.
Okay. Yeah, it was a brilliant idea. Tell me what you're working on right now with EMQQ and the other related funds. Are these just indexing in different markets, emerging markets, or how do those all work?
Yeah, these are index funds, but they're indexed to a very narrow sector. So what we're investing in is the emerging market internet sector.
Okay.
So the FANG stocks, think about our lives and our stock market, right? For the last 25 years, there's been this massive S curve of growth as the FANG stocks took over our lives and our stock market.
Yep.
And what I've been focusing on is how that same thing goes to emerging markets. First in China, which if you look at my main business, EMQQ, which invests in all emerging markets and just in the internet sector, it's had an average of 35% revenue growth. The sector has for the last decade, which is incredible. Probably the fastest growing sector in the world. But most of that's been China, right?
Hmm.
We had the FANG stocks, but China was right behind us with Alibaba and Baidu. So our S curve, when did millions of people in the developed world first have computers and first have the internet, right? And could go online and buy things? That was people like me and you in the year 2000. And the FANG
Hmm.
stocks did this, and they're still going. And maybe there's an AI boost now. China was right behind us. And now
Okay.
China's internet companies are enormous. And now this is coming to India. And so most of my work in the last couple of years has been about the Indian internet sector. Because basically, when you look at emerging markets, again, as a stock market, right? If the S&P 500 defines the US stock market, the MSCI emerging market index defines The emerging markets, these are countries like China, Brazil, India, Africa, Eastern Europe, and there's also frontier markets, which are like the junior emerging markets. And the story in those markets, first of all, the indexes are terrible. The reason that a lot of people look at the emerging markets and they say the Vanguard emerging markets fund, it's gone nowhere for 10 years. The problem is the companies in the index, they haven't grown.
Mm,
The revenue from the emerging markets for the emerging markets sector broadly, the MSCI, it has declining revenue and it has declining earnings in the last 10 years. And the culprit is largely the government-owned banks and oil companies.
okay.
The S&P, imagine if the Department of Motor Vehicles was one of the stocks in the S&P 500. Not these Chinese government-owned banks, Chinese government-owned oil companies. The Brazilian state-owned oil company Petrobras is the best example of this. These companies, they're inefficient, they have serious conflicts of interest, and they're usually corrupt. And the people that are running the companies are frequently stealing money from them. And most importantly, they don't care about growing their earnings. And as an Omaha person, investing is really simple. The reason any business or investment has value is because it makes profits for the people that own the company or
Okay.
the property. And the only way to grow the value is to grow the profits. And the state-owned enterprises, they don't care about that. And they're 80% of the China index, and they're 30% of the broad MSCI emerging markets index. So what I concluded 10 years ago or 12, even no, 15 years ago, longer, was if you're going to invest in emerging markets, you can't use the traditional index. You can't use the iShares or the Vanguard. You have to get more targeted. The original thing that I told people to do was buy the consumer sector,
Okay.
buy the food and clothing companies, because what's emerging in emerging markets are 6.5 billion people that want stuff. They want more and better food, more and better clothing. They want a air conditioner and a heater. They want to go to a movie. They want to get on an airplane for the first time with a $19 plane ticket and take a vacation. They want a car and they want their kids to go to Harvard.
Yeah.
And I didn't have to figure that out. That was well documented. And so that's what I've been largely focused on. And people would ask me frequently, what's the best emerging markets ETF? And I would tell them to buy the emerging market consumer ETF, right?
Con- okay.
The food companies, the Walmart of Mexico, the Nabisco of China, those kinds of things. And then 11 years ago, I got a phone call, which I answered on my iPhone. And a friend of mine said, what's the best emerging markets ETF for my 3-year-old daughter? And I started to tell them to just buy the food and clothing companies, buy the emerging market consumer sector. But then I had a light bulb moment and I went straight back to my office and I created EMQQ and it launched 100 days later on the New York Stock Exchange. Because what I realized was the best consumer stocks were now called technology companies. And that you didn't want Sears, you wanted Amazon.
Okay.
And so there's one particular company that really stuck out. I knew what was going on in China. I had launched a China technology fund with Guggenheim that Invesco now owns, but there was a company in Brazil called Mercado Libre. Do you know that name by chance?
Free market.
Okay, you speak Spanish. So Mercado Libre is the Amazon.com of South America.
Okay.
Amazon does barely exist in South America. Mercado Libre dominates. It is the largest company in South America now. It's the best performing stock in South America, and it is a monster of a company. And when my friend called me that the morning that I got that call, I was looking at my own stocks and I had some emerging market consumer stocks, some food and clothing companies that I owned, but I also had this technology company called Mercado Libre, which this is probably don't want to go too far into this, but one of the problems in emerging markets is the database. And because you get put into boxes, what are you?
Yeah.
First is what country are you in? Mercado Libre stock trades in the United States on the NASDAQ. So is it a US company because it trades on the NASDAQ? Their offices, their headquarters is in Uruguay, right? There's 2 million people in Uruguay. It's a great place. They've got nice beaches. It's kind of like San Diego, but that's not a very big place. That's not where the business is. The business, the revenue's in Brazil
Okay.
and Mexico And so the database becomes a big problem because Mercado Libre isn't in the iShares or Vanguard emerging market funds. The number one performing company in all of Latin America, the most dominant internet company in the world outside of the United States. It's not included in your iShares or Vanguard emerging market fund
So is this
because either because it trades in the US or because it's headquartered in Uruguay.
so it's like what you were saying before, it's just like, what index are you pegging to? And you have to pick, like, is there a lot of people hear index and they think that there's only one thing, the S&P.
No, and they think
Nasdaq.
it's a benevolent thing, and the reason the index works isn't because it's the best list of stocks, it's because it's free.
Yeah.
Okay, that's why it wins, right? It wins because it's free. Now, in emerging markets, the problem is it's not Google and Microsoft and Facebook and Amazon. It's the China Construction Bank and the Brazilian state-owned oil company and the Agricultural Bank of China. These are not, again, they're not real for-profit companies, and they're full of scandals.
And
And
that's the thing that's turned me off to foreign investments because that's what I've been exposed to when I'm looking at these things. Just tons of corruption, tons of scandal, tons of mismanagement.
and this is another reason to buy the internet companies because the internet companies in emerging markets, it doesn't matter if we're talking about Brazil or India or wherever it is, the smartest kid from every country goes to Harvard or Stanford or IIT Delhi or IIM Ahmedabad or whatever it is. And then I'm not an academic snob. My business partner, Princeton economist, Yale, dean of the Yale Business School. I had a 2.0 at the University of Arizona. So I don't, when I say these things, I don't mean them, oh, fancy. I'm just saying the founders of Mercado Libre wrote the business plan at Stanford.
Okay.
And almost every one of the internet companies in emerging markets is still run by the founder. And that founder was the smartest kid from his country. He went to Stanford or Harvard or IIT or whatever. Then they work for Google or Microsoft or Morgan Stanley. Then they get their MBAs at Harvard or Stanford or IIT Delhi. And then they get funded by US institutional
Yep.
venture capitalists like Sequoia, which manages the money for the Ivy League endowments. Now, that doesn't guarantee better corporate governance. But if Palo Alto based lawyers looking out for US investors are putting together the paperwork to start these companies, and those investors have board seats from the very beginning, that's a way better start than the Brazilian state owned oil company that was ripped off of 5% of all of its contracts for 10 years
Yeah.
by two presidents of the country and a third of the congressmen, all of whom went to jail. Another reason it's not only that this is the best growth in emerging markets, is also the best corporate governance.
Okay. So it's more, you're looking at companies that are serving emerging markets, not necessarily founded, headquartered. They could be, but where they're serving that consumer sector of the emerging markets and they have strong rule of law, corporate governance influenced by places that are a little bit more difficult to commit fraud.
The largest shareholders are, again, largely US institutional
Yeah.
investors, and they are going to do a lot better due diligence and better work in the corporate governance than you are as a small time shareholder. So you,
So their time in the private markets basically primes them when they're ready to go public and then come into a fund like yours.
yes.
Okay. Interesting. Yeah. I have a zillion questions. I'm just trying to think of because I always want to ask selfish questions for my own education. I try and think, oh, our listener probably has these too, but I want to think about there must be people out there who are listening to this right now screaming at me, ask him this. But I feel like this opportunity is almost wasted on me because I don't know enough to know what I'm not even asking. Tell me about some of the political situation in the markets that we're talking about. I guess Chinese demographics. I'm concerned about rule of law, all of these types of things that are threats to the emerging markets. What kinds of things are you on the lookout for when you're doing your classic SWOT analysis that you have to kind of mitigate around some of these common misconceptions or maybe it's a correct assumption from the public and maybe it's the public misunderstanding something, a myth.
Yeah. Here's what I would say. Look, there's about 25 emerging markets and another 20 or so frontier markets. So there's
Okay.
45 countries essentially. And there's nothing homogenous about them. So the
Yeah.
risks are varied in multiple ways. So, as are the opportunities. And the reality is that China and India really stand alone in terms of the size of their opportunity. And China has a long list of fears and risks that are well documented and have been actually in the last 6 weeks playing out in a violent way in the stock market because, and this isn't new. When I first got involved with China 20 years ago, there were already people that were sus on China. And one of the things that I've realized, in the last 20 years is that 95% of the people I talk to, they've never been to China and they've never been to India. And so it's all very foreign to them and
Mm.
it's abstract. And they have no knowledge of the history of these places. They have no on the ground experience. All they have is the headlines. And the headlines in the case of China over the last 4 years in particular have been nothing but negative. And you had two different narratives that played out over and over in the headlines, and that becomes people's reality. And they see the headline. The two narratives were the China tech crackdown, that Xi Jinping was mad at Jack Ma and Alibaba, and they stopped the Ant Group IPO, and Jack Ma was missing. The narrative was that Xi Jinping and they hate capitalism and they hate the internet. And the other one was they're going to delist all these companies, that they're not following the accounting rules and they're not in compliance with the US accounting rules, and we're going to kick them off the stock market and you're going to lose all your money. Now, both of those things were totally stupid. If you really understood them, both of them are ridiculous. And in terms of the India tech crackdown, the Ant Group IPO, which is what they halted, Alibaba's financial service business, that's the reason Jack Ma was missing because he made a smart aleck comment at some conference. And again, this is the narrative of the headline in the news
Okay.
here. And that Jack Ma was out. Xi Jinping said, I don't like this guy. Stop the IPO and bring him in and torture him. He's walking his dog and a van pulls up and they throw a hood over him and they bring him into a underground, rough him up, right? Which is outrageous. The reason Ant was going to be the biggest IPO ever is because it was an absolute gusher of profits, but most of the profits came from making loans outside of the regulated financial system. And Jack Ma may not agree with the Basel Accords, which are used to limit systemic financial risk by making sure everything's within the regulated financial system. And Jack may not have liked it. His comment that he made was that the Basel Accords were a club for old people, which is true, but they had to stop the IPO because they were going to have to change the rules to get Ant back inside the regulatory structure. So I applauded that move, but everyone else thought, "Oh my God, it's a heavy hand." But what I realized, it doesn't matter what I say. If everyone else sees the headlines and thinks something different, then that's going to be the reality.
How do you overcome that kind of stuff when you're attracting investment into a fund and they're like, "What? Where's
Well, we
the
haven't been able to
money?"
attract it for the last few years. It's been a little tough to attract investments
Yeah.
into our fund that includes China. We have an ex-China fund and an India-only fund, but people, China became uninvestable. That was the quote that
Mm.
Jim Cramer used. And
It's not Gaza.
like Russia's uninvestable. They actually only you can't buy the stocks, but it wasn't real. In fact, there's a great piece in the Financial Times from the chief economist from Rockefeller about this. China was always investable. It was a stupid tagline. It was a attention grabbing headline, uninvestable. And almost by definition, that was the best time to buy it when everybody had thrown it
Mhm.
away, right? And all the money left China funds and it went into emerging markets ex China. So now there's, again, this is very timely because the last 6 weeks is a huge reversal where people finally say, well, you look how cheap these things are. And oh my God, they've also got high. And even though they had a big bounce, they're still cheap. They had a decent dip today because Trump and the new government is, I think, setting the stage for their China negotiations and they shot a shot over the bow today. I'm actually optimistic Trump and Xi will work a deal out that it takes a lot of the tension out of the China US relationship. But China sticks out as it's been the biggest part of this emerging markets internet story with the Alibaba, Tencent, et cetera. And it's also just been a constant point of fear with people,
Yeah.
right?
Yeah.
I can't control the headlines. And the delisting thing was completely ridiculous. That got resolved. The problem is the negative headlines show up on the front page over and over. And then when these things get resolved, it's like on the back page and no one knows about it.
Yes.
So anyhow, that's definitely a risk. And it has been a problem.
I haven't been to China since 2001. I've never been to India. I don't think we can have a conversation about investing in China without addressing the human rights questions. I remember years ago, I was watching a TED talk. I think it was by a Chinese laborer, and she was talking about like in China live Chinese people looking for jobs, looking for opportunities to help our families grow. And it was in the height of when it was very popular to boycott anything made in China or Chinese goods. We're going to boycott Walmart because they have all the Chinese goods coming out. And I remember seeing that thinking, and when I was in China, it's a bunch of people trying to just do the best for their family. And I want to be able to support those efforts, not boycott factories that are making Chinese goods. But at the same time, where does human rights come into this? Where does the conscious investor, how do they make these kinds of decisions about where to invest in these types of markets?
I appreciate your opening statement about these are everyone's just a person trying to do what's best for them.
Yeah.
As far as I know, there's no evil country out there where all the people are evil. There may be governments that do things, but even there, you have to put yourself in like how did they get there? It's not like Xi Jinping took a democracy and said, "All right, I'm making it a communist country." These people inherited what they've got. I think that the human rights look, China's a communist country, and it's not the United States. I think 99.9% of the people in China don't feel like human rights are challenged in any way, shape, or form. And I think a lot of the narrative has been around the Uyghur
Yeah.
population.
Don't buy anything on Temu or consumer goods or clothing because it's
I,
slave
I
labor reported.
again, I just think that's ridiculous. The Uyghur population is tiny. They have plenty of low cost labor that would love to have jobs at these places. The idea that they're resorting to enslaving the Uyghur population to make Nikes, I just think it's far fetched. I really do.
So,
Uh,
what do you make of it then? Like, how do we reconcile, I guess, the headlines with I don't live in China, right? But I was there during the Hainan spy plane crisis. And that was pretty tense. Like, we were a little concerned about getting home and all of the face saving that was going on. And that was what made me realize, like, I am in a foreign country right now, the way that this whole thing was playing out. So, I feel like there has to be some middle ground between that's where the truth can actually be found.
all of these places are you can't understand them completely. There's so much nuance and element to all of these massive places that you can understand pieces of it, but I just I think China is what it is. It's a massive economy that's the most technologically advanced country on the planet. It's an emerging market, but when it comes to the smartphone, it's the Jetsons. There's no place more technologically advanced than China is today. People would be shocked if they went and they saw the infrastructure of China, the just everything. It is the Jetsons, but it remains a threat, at least in the minds of America. And we had the reason that China was down today is that president released a piece about largely focusing on our adversaries like China, and that's not going to go away. I think it's a pretty abrupt change from the globalization and free markets that were going hot when I was getting educated in the professional world for the first decade, but the world's changed and we feel threatened by them largely because they're successful. And so I don't expect people to all of a sudden warm to China. I do expect that Donald Trump and Xi Jinping will meet in the next few months. And I think, as Donald Trump has said, if China and the United States could work together, we could solve all the world's problems. And with Elon Musk now part of the president's thinking, and he's the most successful entrepreneur in China. He's
Yeah.
raved about the skill of the Chinese engineers and work ethic, and I think he's right about those things. That has to affect, I think, Trump's approach to this. And also, Elon Musk's mom, May Musk, is famous in China. She is a hero to the mothers of China. They adore her, and she's all in on China, as is Tesla. Everyone else said China was uninvestable. Elon Musk was investing billions of dollars and building a big business in China. So again, who knows what will happen in the coming weeks? As there's a lot going on right now, as you and your listeners know.
Yeah.
But I'm optimistic that there will be some kind of a resolution, some kind of a handshake and a go forward between the US and China that won't be as adversarial as it has been in the last 10 years.
It reminds me almost like growing up in the '90s and having Japan. Like, Japan's gonna take over, the economy's crazy, we're all gonna be basically suffering because Japan's gonna
Yeah.
own everything, do
They bought
everything, and
World
then
Beat.
nothing came out of that. I don't know if it was a demographics issue, I don't exactly know what happened, or you just have that rapid rise one time, credit funded, government funded, however you wanna fund that. You only have one bite at the apple. China's gonna continue to grow. India's gonna continue to grow, but we've already seen the peak of the growth rate.
For China, the reality is China's in the last 20 years, GDP has had 5x growth. GDP per capita has had 5x growth. It's still not a developed market in a traditional sense, but it's way ahead of India. And so India, people don't want China. India is in many ways the answer because first of all, it's the largest democracy on the planet. They just had maybe the best functioning democracy on the planet, I might add. It's like China was 20 years ago. And it really is a very special situation. The reason that people are invested in emerging markets or interested in emerging markets is that they have a lot of people, they have better demographics, and they have faster growth. And that's driving consumption, right?
Mhm.
Everyone else wants food and clothing and movies and so forth. India now is the largest country in the world.
Yeah.
India passed China 2 years ago. And today, India set a record as the largest population ever on the planet.
Yeah. I'm definitely more bullish on India. I'm a little bearish on China, but I feel like what you're talking about, that rate of growth that we're getting a glimpse of in India, that's interesting to me.
And it should be, and the internet part of the story is the best part.
Yeah.
So you got the biggest population, and every day it sets a record as the largest population ever because China's demographics now, when I got involved 20 years ago, China had different demographics. Now they look like a European country. India is growing every day. India's got twice as many people under the age of 30 as our whole population. If you leave out China, India is bigger than every other emerging market combined.
Okay.
Okay. Indonesia is number two with 280 million. So India is 5 times bigger than Indonesia, and it's bigger than all of the other emerging markets combined. Best demographics, fastest GDP growth, and that's driving consumption. And if you look out to the future and add those things together, it looks like India will pass China in terms of consumption in the not too distant future. And it will be significantly larger. So on paper, India is absolutely perfect. Now, then the question is, okay, where was India? Like, where has it been? Why is India all of a sudden in the headlines? And I also, as I mentioned earlier before we started the webinar, it's pretty important, I think, to understand these countries and where they came from. Like, how did India get where it is today? And the reality is the country's only been free for 75 years. For essentially 300 years, the British essentially colonized the place. And not the British government, a British company, the British East
And a
India
great
Company.
company.
They had the largest army in the world owned by a private company in India, 250,000 soldiers. So the place was looted. That's an Indian word that was taken over into English. But before the British got there, they were the richest country in the world, led by the Moguls, another word that we've adopted. So 75 years ago, the British finally left and very hastily, and India became free. But they inherited a lot of bureaucracy and a lot of socialism. In the last 11 years under Modi's leadership, and Prime Minister Modi is one of the two most important people in the story, he's come in with a machete and he's slashing the red tape and trying to make it easier to do business. And he also invested in the infrastructure. When I got involved 20 years ago, China and India had the same GDP basically, but every year China was building the world's greatest infrastructure. They couldn't even get the power to work in India, right? For a long time. And so it was hard to attract manufacturing, semiconductor manufacturing. If the power is going to go out in the middle of the day, it's hard to operate.
Yeah.
So Modi has doubled the infrastructure in the last 10 years or 11 years. and he's again running the country like a business. But India has two other important things that you're not going to find in other countries. India has a tech sector that's older than me. You have publicly traded tech companies like Infosys, TCS, and they've been publicly traded for decades, billionaire founders. They've employed millions of technologists and managerial talent, most of whom have gone to India's best colleges, and they have world class institutions. The IITs are modeled after MIT, and they're some of the best schools in the world. The institutes of management as well, some of the best business schools in the world. And they produce world class talent, and you don't have to look far. There's 25 S&P 500 companies with Indian CEOs,
Yeah.
including Google and Microsoft.
Yep.
So you're not going to find that in Indonesia or Vietnam or Brazil or China.
If we're going to look at our private fund from a statistics standpoint, most of our investors are just Midwestern Americans, but the second biggest group is our Indian nationals, not second generation, like individuals who were born in India, came to the United States to work. And I don't know what it is, but they are bullish on investing in general and make some of our most enthusiastic and they just invest a huge portion of what they're earning. There's something about Indian culture, not just owning real estate, but just investing in general. Have you seen similar?
Oh, absolutely. The non-resident Indians, NRIs, if you look at the different subgroups of Americans and the average income, the richest group in America are the Indians.
Yeah, yeah.
And they make 3 times the national average in terms of income. Educated and industrious, the deans of many of the best business schools in the world in India. These are very talented and proven. And again, everything's relative in the world. People say, "Oh, I'm excited about Vietnam or Indonesia," but India, first of all, India is 15 times bigger than Vietnam. You're not going to find 25 CEOs in the S&P 500 from anywhere else. Not from Europe, not from Canada, the United States, obviously, but so you have the world's best human capital. Importantly, they're becoming entrepreneurial. 15 years ago, the Indians didn't come to Silicon Valley. They would want to work for the Indian government, right? I want a safe, stable job. That's gone. The
Mm.
number of startups has gone from 500 7 years ago. There were 500 startups in the country. Today, there's 120,000. So you finally have entrepreneurism taking hold in India, and they have their own Shark Tank now, season
Mhm.
4 going on. So you've got an entrepreneurial surge. And then the final part of the India story, which is hard to explain, but India has a secret weapon that is called the India Stack. And it's digital public infrastructure, which sounds boring and abstract, but digital public infrastructure includes the internet, it includes GPS, right? Those are the best examples of what digital public infrastructure is.
Is it similar to, I don't know, maybe 10, 20 years ago when India didn't have the phone infrastructure and cell phones became everybody had a cell phone even before every American had a cell phone because we had wired lines and they didn't. So they had to
Ye-
go a little bit more wireless and did
Yeah, they leapfrogged on that.
okay.
There's definitely in all of the emerging markets, there's a leapfrogging going on. They
Yeah.
skip all this step. We've had a very gradual experience with technology, a gradual experience with consumption. In emerging markets, at least people are jumping to the front of the line, if you will.
Yeah. Paying
Um,
attention and doing it better.
yes, but let me tell you what this India stack is because it's actually genius and it's not well appreciated. It's digital public infrastructure, things that are digital, they're free, and anyone, they're like the pipes, right?
Yeah.
I don't get a bill from the internet. I don't get a bill from GPS. No one says, here's your payment for the satellites. I'm assuming that the costs come in somehow, but I didn't make the internet. I don't know who made it, but I'm using it
I was
right
born with it.
now. And these things are important because you can build businesses on top of them. Could Google exist without the internet? No. How
Yes.
about Uber? Could Uber exist without GPS? No. So these things are very valuable. We use the roads all the time and the physical infrastructure, but we don't really see the digital public infrastructure. It's there. We're using it. You don't have a satellite floating over your house or you can see it, right? So India has the internet and they have GPS, but they've also got their own homemade stuff. This is the real game changer. And this stack, the reason it's called the stack is if you made a picture of this, it looks like a stack of pancakes. There's all these different layers that are each separate programs that are nonprofit, started by the government, but built by private enterprises, but all on a non for profit basis. And the foundation of the stack is called Aadhaar, which means foundation. And it's a national identity system. So hear me out on this. One of the problems India had in developing was that only 17% of the people had any form of identification. Okay. A physical ID card from any reputable organization, right? The government organization, a government issued ID card, less than 20%. Only 40% even had birth certificates. There's a lot of people in India that have no idea what their birthday is, or even what year they're born in some cases. So it was a free for all. And as you can imagine, it's hard to modernize your economy when you can't prove who you are. In 2009, they decided to address this problem and they launched this program, Aadhaar, to give everybody their own physical identity card, okay, with their picture and their name and their information, right? And their own 12-digit number. And they asked this man named Nanda Nilekani, who's one of the founders of Infosys, to be in charge of this, to give 1.5 billion people a physical ID card. Okay. And he's also the chairman of Infosys right now. He's the chairman of the biggest tech company in India. He agreed to do this, but he said, if I'm in charge, I'm in charge, and we're going to use a lot of technology. And when people sign up to get their card, we're going to scan their fingers and their eyes so that every single person in the country, not only do they have a physical card now, but they can be instantly verified as who they are just by walking in front of a camera or putting their thumb down. Okay. That was launched in 2010. The entire country is now in this database. In 2014, they launched a program and they said, all right, if you're in the database, you can walk into a bank and open a bank account with no paperwork. Okay. And you remember, they had almost no financial inclusion. Everybody's life was paper based cash hidden in their house and some gold jewelry hidden in their house, right? 800 million Indians went into a bank and opened their first ever bank account in 2 minutes. So in 7 years, you've taken this country from no financial inclusion to digital only bank accounts. Now, all of this stack has got open APIs. So the other use of this that was an aha moment in 2016, when they launched the first 4G mobile network called Geo, there was about 10 different mobile carriers, all that were offering 2G coverage, right? And they were all in a price war. So nobody even invested in 3G. Geo bought the 4G airwaves and spent $25 billion covering the whole country in hardware, state of the art, ready for 5G and 6G. At the time, it took 3 hours at a minimum to get a new phone. It could take 3 days before you could get a new phone. All of this is open APIs. Geo signed up 100 million people in 100 days just by using your thumb and looking at a camera. So that deployment of technology has gone financial inclusion at population scale, high 5G, high speed internet access, lowest cost data in the world now, 500 million people on Geo. And that's just one layer of the stack. There's an instant payments layer, which is the second most important layer that was also launched in 2016. And now I don't have the chart with me, but the growth of the digital India it's the classic hockey
Hockey
stick,
stick.
and it's still early. It's still very early, but India is now home to more than half of the world's instant payments. This isn't Apple Pay. This is you push a button and instantly your money's in my account.
Like a wire. Not
No,
like
no
an
fee. Zero,
but no
no
fee
fee.
for it's like
It's like
automatic
Venmo.
ACH, an instant ACH.
It's an instant ace. Literally, it's like sending a text. I send you 1,000 rupees. It goes instantly from when I push the button, it's instantly in your account. And it's still 1,000 rupees. And
Yeah.
you could send it around a million times and it's still 1,000 rupees. Since that was launched, when the smartphones got there, the 4G, India's digital economy is exploding. And 7 years ago, the entire economy, 95.5% of the economy was paper currency. Today, it's 80% digital.
Hey.
you can't use cash in a lot of places. And people are now they're paying their taxes because they also simplified the tax code and took out the large denomination bills. So this India stack, I've only touched on this a little bit. You can go through airports now. All your documents are kept in the DigiLocker. So your diplomas, your passports. Now that you have a financial track record with this payments, you can get credit because you can make your own credit score. Here's my data, share it in an encrypted way and get credit. So this is a real secret that India has. So India is kind of China was 15, 20 years ago, except when China was in this stage, nobody on the planet had one of these. And the advance of this device in the last 15 years, from not existing to dominating our world, is a big, important difference because now you can get a brand new smartphone in India for $12. A
Oh,
brand new smartphone for $12. And then you put it on top of this digital ID layer, this all of this digital public infrastructure. This has not happened before. So India investors should be buying and holding India, and in particular the India internet sector that we invest in, because this is
yeah.
early days.
Yeah, a lot of interesting stuff going on. You've given me some good stuff to think about as well, some rabbit holes that I can go research, get behind some of the headlines. Now, let's shifting gears just a little bit as we kind of wrap up. We're talking a lot about lifestyle design and the adventures that we go on when you take care of your financial freedom and being able to figure out, I want to give more, I want to travel more, play more, all of the things that people want to do. I want to build a business, whatever it is, figuring out how are you going to keep your lights on, pay for your food, pay for your car, all that kind of stuff. But you did mention you're more of a capital appreciation type of a business. So for those who are seeking income, they're looking to retire maybe in their mid 50s, before 65 for sure. How can they get involved in these types of things and still be taking care of their cash flow needs?
Sure. The strategies that we have, which are ETFs that, again, INQQ tracks the Indian internet sector,
Mhm.
EMQQ tracks all of the emerging markets, including India, but also China. They don't produce a lot of income. There's a little bit of dividend income, but not certainly not the kind that your listeners are looking for. So this is a long-term buy and hold retirement kind of investment.
Okay.
Presumably, even if you're living off your cash flow, you still have some
Yeah.
pile of assets and counting on long-term appreciation of those.
Okay.
And I believe that this India story right now, it's so early, whether it's online travel or online food delivery or any of these beauty products, right? These areas are going to grow for 20 years. And it's so early. And the miracle of compounding is one of the most important things in the world, and certainly in terms of investing. And it doesn't matter if that's in real estate or in stocks or any other investment. The longer that you can have that growth of value, the better it works. And if you can have fast growth at the beginning of that sequence, then even better. The Indian internet economy in the 8 years ending in 2030, so we're in the first half of that period, from 2022 to 2030, the Indian economy will grow about 100%. The Indian internet economy will grow about 500%. And so if you have long-term money, buy it and don't look at it for 20 years, just buy and hold and for your kids or grandkids or when you do get to retirement, I think this is a place you'll get significant appreciation. It won't generate a lot of cash flow, but if you want longer term investments that'll grow significantly in value, I don't know of a better place than the Indian internet sector and the INQQ index that we have that tracks that.
Yeah, you've been around this block for a while, so it's an interesting perspective. Plus, you have the advantage of liquidity. Honestly, in private markets, one of the reasons they're not as volatile is because they're less liquid. People aren't getting valuations done all the time. They can't panic sell. And so when you have liquidity, yeah, it's like a pseudo kind of cash flow.
Yes, this is very true. And then Burton talks about this a lot, especially with the Ivy League endowments. You get paid a premium for lack of liquidity. That's so we provide liquidity, but it is volatile also. We've had many major corrections in the space along the way, and I'm sure we will again. But long-term investors, I should point out the Indian internet stocks had a bubble that burst in 2021. burst before we even launched our India internet strategy. But even though it was already burst, our first year, it was down, we were down 50%, even though we launched 6 months after the top. So we still haven't gotten back to where we launched in 3 years. So th- a lot of stocks are at all time highs. The Indian internet stocks are below their highs, but so early.
That's when you buy more. Buy low, sell
Yeah,
high.
that's
Yeah.
what you ought to do, but it's always hardest. People,
Yeah.
the idea of Mr. Market, right? Warren Buffett idea, the stock market's your business partner, and he's very emotional. And sometimes he's super bullish and wants to buy your stock, and sometimes he's super bearish and wants to sell. And he's there for you, but you got to avoid letting him influence you by his emotional swings.
Yeah, we call that the stock market wife, but it's probably a little sexist, but
Yeah, we a bit call it Mr. or Mrs. Market.
there you go.
Ben
There.
Graham and Warren Buffett call it Mr. Market.
Funny. That's funny. Do you mind if I ask you a personal question?
No, I don't mind.
If we talk a lot on this show about people's personal plans, people's personal journey, their own lifestyle design, especially those of us who've gotten to the point financially where we're financially free and we don't have to work anymore. Finding purpose and finding fulfillment. How do you do that? And what do you see over the next, say, 5 to 10 years in your own life, your trajectory of adding to your level of personal fulfillment?
I like working.
Me
I've
too.
always liked to work, and I don't think of it as work. I have the best job in the world. I go to India for a month and spend time with entrepreneurs and founders and people like Nandan Nilekani, the founder of Infosys, and eat the best food and see. I love history and I love cultures and just learning about them. And then I come back to San Francisco and I write a report about what I learned. And then I go to, as I will in next week, I'll go to London and Madrid and Milan and Geneva, and I'll tell those people what I saw in India, and I'll eat their best food, and then I'll come back and do it again. I don't, why would they want to?
Do anything else.
Yeah. So my joke is I'm trying to combine Anthony Bourdain and Mark Mobius. Mark Mobius is the legend of emerging markets. So I'm a new age Mark Mobius meets Anthony Bourdain.
Yes. You cracked a joke before we started recording that you talk for a living. And I'm like, man, that's what I am moving towards in my own business, where I just meet people, hear about interesting projects, collect data, tell stories, and network. It's a great place to be. Are that kind of where you're seeing yourself over the next decade or so?
Yes, I think absolutely. Now, my youngest child is now off in college. So my
Mhm.
wife and I have a little more flexibility. A month in India, a few weeks in other places, and then a couple months in Europe, going from city to city and just enjoying life and talking and educating about this stuff. So I think that for the next decade, for sure, this will continue to be my focus. But even after that, I'm just investing in general. More and more people are trying to learn more, trying to get a better understanding and do it. I'd like to think I can continue to help getting people to do things the right way. I think I did enough of developing the plumbing for it. Now it's about getting people to use those things and use them the right way to optimize their own financial outcomes.
When things get really stressful and things get really hard, how do you get through that when you're like, I don't have to do this?
I go for a bike ride.
Yeah.
I bike an hour in the morning and an hour in the afternoon every day. So that helps me avoid the two big ups and downs of those feelings. But I don't know, my main escape.
Yeah, I find the same thing. I go hiking. Moved to Utah, it was like, look at all these mountains. What are those from Texas? And we started walking around in them, and it made us want to quit everything less. It made us more motivated to get back and just do a good job on anything that we chose to undertake. We're going to undertake and do it well. And there's a lot of motivation out there in those kinds of things.
Yeah. One of my mentors used to tell me that productivity was the basis for morale.
Oh yeah, that's a good one. That's gonna be our little YouTube short right there.
So they might not be the case for everybody, but it definitely is the case with me.
Yeah. I appreciate you spending some time with me, with my listener, to educate me on this topic, because I've been noticing over the conversations I've been having over the last couple of months that this is an area that I'm very weak in. And I've just been getting more and more curious about how I could be doing a better job of staying with my kind of, the index is going to beat me every single time, but yet exploring that a little bit more as I'm diversifying my own portfolio and offering something very targeted for our investors. Yet at the same time, because we're targeted, we understand like we're only one piece of a strong portfolio. So I appreciate you educating us, sharing your vast experience with investing, with being in emerging markets and walking your talk. And like I said, giving me some new research rabbit holes to go down and see what I think and just trying to find some stuff that's good fit for me. So, how do people reach out? If you want them to reach out directly after the show, do you want to give them some resources where they can invest with you?
People can reach out to me however they like. I'm on LinkedIn and with my name and EMQQ. You shouldn't have trouble finding me. Or our website is emqqglobal.com. So we're not too hard to find, and just send me a note on LinkedIn or find my email and reach out if you're interested. But that's probably the easiest way to find us
And on all the publicly traded platforms.
in the New York Stock Exchange.
Robinhood would it's your choice where you want to find EMQQ. Like just type it in, there it is. So part of the ease of public markets is just so much easier
It's
to find
definitely
and
part of the
small.
ease of having an ETF business. There's no paperwork for me. You just got a ticker, you got an account, go find it.
Exactly. We got all the accreditation letters and the PPM and all this stuff. And I don't want to deter investors from doing private markets or public markets, but public is definitely easier.
Yeah.
All right. So if you want to reach out to me, I would love to talk to you after the show. We're all learning together. We're all just networking, trying to figure this whole thing out. So you can get a hold of me at partnerwithrise.com/Emma to get directly onto my calendar or also LinkedIn everywhere. I'm Emma Powell 28. So I will see you all next week when we're going to talk more about how to help you pay for your own passive income adventure.